Good. Now, about half of what Jan said is actually true. No, it's all true. It's all true. Yeah, it's all true. Hey, Chuck and John, I wanted you to know, I checked with Lee before we came out. Because you've sat here in the front row for 10 years in a row, next year you get to sit up here with us.
Oh, thank you.
You're happy about that? No, okay. Well, again, thank you all for coming, and Jan, thank you for that. It was a great tee up for what I want to talk about for the next few minutes, and that's the road ahead, a dip or a blip. Now, I had the good fortune to run into a group of students from Hokies who run the hospitality program, and their professor, Gary Walton. And so I asked them the question that I knew was a great question for the students, and that is, what's the difference between a dip and a blip? Now, by show of hands, how many of you actually thought about that before? That's what I thought. No, nobody at all. I asked Joel Eisman that earlier, and he said one letter. Yeah, it kind of took me a while to. But is there a difference between a dip and a blip?
You told me to ask you last time, sorry.
Chuck?
Sure, and Jan explained it, with September being the only month out of the last 108.
Yeah, so what Chuck just said is John explained it, and that he's right. It was September of last year. You'd say that was a blip, because it was a clear trend that Jan just walked us through, but there was that very short period where there was a departure from trend. And so understanding that blips can go up or down, but the key is they don't change much, and it's short-term in nature, whereas a dip is more of a, not more of it, is a downward change that with some level of duration associated with it from the trend that you've been on. So as I go through the deck, we'll explain to walk you through why we think we should be expecting one and not the other in the years ahead. So here's what's in the deck. The ADR conundrum, and then we'll end up with our forecast. Just kind of a heads up, there's 38 slides here. The first 30 have nothing to do with, well, are not our forecasts. Okay, it's information that we're thinking about that feed into our view for what's going to happen going forward. I've learned over the years of doing this by talking in front of hotel groups and so forth, it's really good to tell people ahead of time what they're supposed to get out of it. So it makes it hopefully a little more meaningful. So here's today's message. By the way, for those of you that saw Adam yesterday afternoon, I thought his presentation was terrific. Our house view as far as the economy going forward is very much in sync with tourism economics in Oxford and so forth. So the outlook certainly we're very comfortable, looks good through the end of next year. The fundamentals of our industry that again, Jan just walked us through, we think are going to remain very much intact. Nice balance between changes in supply and the demand to help absorb that supply. We do think there will be a blip, but that's not going to be in 2021. And so let's get into some of the numbers. Some of you may have seen in the past, we do like to periodically look back and understand, as we study the 3 cycles that we can study because of SDR's data, that each one of these, either on their own or sometimes one or two happen together, have caused there to be a market change, i.e. a downturn in our industry. And the first one I want to talk about this morning is the economy. So the economic discussion in our industry needs to begin with an understanding of where the GDP change has been, and critically what the expectations are going forward. If you look to the far right of the forecast line, the trend line that you see is very much in a downward direction. Hard to read the numbers, but GDP growth in the first half of 2020 is expected to get pretty close to zero. Not go negative, so technically not falling into recession territory, but it is going to be a very, very noticeable soft patch that we think is going to hit the U.S. I'm going to spend a few minutes on this particular chart that we discovered last fall, and we've been updating it since then. But what you're looking at here is that, I guess it's a green line that kind of slopes gently downward from left to right. That represents the theoretical natural rate of unemployment. It means certain people are just not employable, and you can see that that's changed a little over time. The blue line that you see that jumps up and down is the most frequently cited unemployment rate, which is the U3 rate put out by the Bureau of Labor Statistics. So what we're interested in is when that that blue line, that U3 number, drops below the natural rate of unemployment, and what the Fed labels that as being a high pressure period. Okay, and you look on the far right, we're into the red zone again, and the gray bars that you see represent recessions that we've had. And understand the data begins in 1960, so that's now getting close to 60 years worth of history. So for almost 60 years, every time, or 50 years, every time we've fallen into a high pressure period, it ends in a recession. So therefore, connect the dots, what lies ahead?
More growth.
More growth.
Recession, sorry.
Yeah, well, you'd think it would be a recession, right? And we're in the red now. As I look at it, what's kind of interesting is it does always end in a recession, but the length of that high pressure period does seem to vary. Okay, so the logical question then would be, well, how long are we going to be in the red zone before the next inflation? Okay. So when you look at 50, 60 years worth of history, you start to say that's pretty compelling. Okay, because history to some degree, you'd say, does repeat itself and so forth. So what do we make of this kind of ending in recession all the time? There's some possibilities. This time around, it might just be a coincidence, okay? Because you play with data, like Jan says, you massage it long enough, you can get it to tell you the story you're looking for, okay? So what we would point out here is this concept of a spurious correlation, and that's demonstrated here, where if you look historically, the number of letters in the winning word of the Scripps National Spelling Bee correlates almost perfectly with the number of people killed each year by venomous spiders. Now, Chuck, I know you're going to sit there and try to figure out what is the relationship between those two, but the answer is there is none, right? There is none. Huh? You figured that out already. Okay, good. So maybe it is just a coincidence. It's not going to happen again. There's imbalances. Arguably, the economy's been good for a while now, so maybe there's creating some pressure points. And one of the things we look at is the covenant-light volume of lending that's been going on, and this is global data, billions of U.S. dollars, and you can see, covenant-light means lenders are getting more lax with their willingness to put capital out. So does that mean are we now getting into a bubble of sorts? On the debt side, and in the housing markets, that's what killed us 10 years ago, right? So something we're watching closely. But the chairman of the Fed, Jay Powell, read this quote from here. He doesn't think it's in the banking system, so it's somewhere else. So it looks like we don't have to be concerned about a repeat of what we saw 10 years ago in the crisis that followed. We do know the Fed historically has overreacted in terms of some of their policy decisions. Some of you, most of you probably heard that they announced yesterday no more rate increases this year. They're slowing down the buyback process somewhat. But the next thing we're thinking about is this notion of a fiscal reckoning. And that is if you look at the volume of federal debt held by the public, okay, and you see to the far right what the projections call for, we're very quickly going to be getting into uncharted territory, getting back to where we saw at the end of World War II. And so, how do we work ourselves out of that could have some very big implications on the economy as a whole, and then within that, obviously, the lodging space. So Jan touched on some of the BLS data that deals with wages and job growth and job openings and so forth. But if you go back for over 100 years now, what this data represents is the change in the working age population for that decade. Okay, the idea being is the working age population grows, definitionally we have more people entering the labor force, and so the supply of workers helps ultimately to drive economic growth. So if you look over time, you can see that number, certainly going back to 1980, and by the way, that was when women first entered the labor force in big, huge numbers, and it did have a big impact on our industry back then. But importantly, if you go forward, the expectations for the increase of the working age population are really, really limited. Okay? And I'd like to ask the question, how many in the audience today believe that we have a well-conceived, functioning immigration policy here in the United States? We don't, right? It's totally so there's no hope on that front and so forth. So again, another thing that we're watching very, very closely. Labor force participation rate, these data are the exact opposite of what I would have assumed. What we're now seeing is that As people age, they're staying in the labor force longer than they had been. And then the opposite is true with respect to some of the younger age cohorts. So again, this is where the workers will be coming from and so forth. There's another whole discussion as to why that is. Some has to do with younger folks staying in school longer. The opioid problem is a real issue, and that's hurting labor force participation. So consistently, people like us have been saying, don't worry about the new supply. There's again, this nice balanced change of new rooms coming in, the demand showing up to absorb and so forth. So again, number 2 on the list was the overbuilding question. And we have not been concerned, and we remain unconcerned about what that looks like. Adam had this chart. I think, I can't remember if you had it this morning as well. But there's a historic change. That's where we are, and relative to previous peaks. The next few slides, I want to focus on that area that's in the circle, okay? For over 2 years, using STR data, you can see that the volume of rooms under construction has been flat. So one would look at that and say, it's pretty clear we seem to have plateaued on the rooms under construction domestically. So we're going to focus in on this little window. Okay, and that's that same period. And you can see it hasn't changed much, but that's where we are, right there. And now we want to add to that the number of rooms, the stock that's in the final planning stage, so i.e. it's getting ready to enter construction, break ground. And then we add to that the planning stage. Now some of you may have noticed on one of Jan's slide, that in-planning number was actually up, I think it was 43%
Yep.
Year over year. And I think when anyone's measured, they would say that's a pretty big jump. So that caught our eye, and that's that gray line that you see shooting up. So we all know from a development perspective, I have to enter the planning phase to get to the final planning, to get ultimately to under construction. We do know there's fairly high attrition rates that are there. But again, that line jumped out at us, so we thought it'd be interesting. Let's drill down a little bit to see where's all this planning activity coming from. What does it look like? And so what we did is we took the STR pipeline data, carved it up by change scale. Kind of hard to read here. The right-hand scale, by the way, is total rooms, all U.S. The left-hand scale is what you look at in terms of the number of rooms by change scale. And the leading change scale categories are upscale, upper mid-scale, and mid-scale. And you saw, again, some of Jan's charts that showed that. So you can see over the past year, there's been a big pickup. So at this point, are you concerned about there could be too many rooms too soon? Because if you buy into our economic forecast, and this idea that we're going to have a slowdown that begins in 2020, the rooms within this group here that actually get done, could be opening up into a fairly soft window come late 2020, and certainly into 2021. If you look at the pipeline data over this past 12-month period, and where are these geographically, where are they going? You see Miami, Indio. Do you know where the Indio is, Chuck? That's exactly right. I didn't realize that until they were showing me the data. And it's the Coachella stuff. There's a lot of rooms that are, but it's like Joel told me, 20 minutes outside of Palm Springs. And so that's one little market. But you can see the rest of the major markets and where that interest continues to be. If you look at the brands, independent as usual is the largest single category, but then you see again, as you would expect from that earlier data, it's a lot in that mid-scale, upper mid-scale category where the rooms are coming. So again, as Jan talked about, we continue to see rate growth well below what history says it should be, given the high occupancy levels or low vacancy levels that we're seeing. So as we think about that, we're going to show you a chart in a minute that supports this. Well, one of the answers to why is rate growth so weak is because we have had supply growth. Again, not too much. We're now at the long run average, but we do know that new rooms creates new competition, and that can affect pricing, both in traditional hotels, and now we have the sharing economy phenomena that we've talked a lot about over the last 3 to 5 years, and that's clearly now making a difference during certain markets, certain prime periods for certain property types. Working with our friends at CBRE, the idea that intermediaries are capturing a greater share of that consumer dollar. There's a difference in the rate of growth that we as customers are paying versus the rate of growth that's coming in over the front desk. Of course, we all focus on that number that comes in over the front desk. So there's some leakage there. And the last thing I want to talk about on this point is this notion of uncertainty. So when you're uncertain about something, what do you typically do? Yeah. You do, as John said, you do nothing, if you can. Okay, or if you can't get away with doing nothing, you try to pause or be slow, whatever. So kind of taking that thought in mind, we look at, and if you're interested in this, I would encourage you to go to a website called policyuncertainty.com. But if we go back to the mid-1980s and we plot out some of the major events that caused uncertainty levels to spike, and they have it for most countries around the world. This is the U.S. data. And if you took the average level of uncertainty that we saw from 1985 through 2007, okay, that just happens to be right at 100 on the index that we have here. If you look at the level of uncertainty that's occurred since 2008 through, this was done through January of this year, mathematically, that level of uncertainty is 30% higher than what it had been for the previous 25 plus or minus years. And if you look at what caused the spikes over the past 10 years, with the exception of Brexit, okay, they're all things that happened that came out of Washington. Okay, most recently, the government shutdown that we had late December, well into the month of January. So we asked ourselves, could this be making a difference? Could it be affecting pricing? Because let's think about it. If the example we like to use is a meeting planner. They typically are going to have to book a certain amount of time in advance to get the product they want and the market they want, ideally at the price that they want to pay. And so we have seen booking lead times shrink, and which definitionally means I have more inventory, unsold inventory on the shelf for a longer period of time. And no matter what business you're in, the longer you hold your inventory, the less valuable it becomes. So conceptually to us, it made sense that maybe this is affecting pricing in our industry, and the answer is, in fact, it has been. We believe controlling for all the other variables that we'd have to control for to really isolate what might the impact have been from this elevated levels of uncertainty. And as a sidebar, there's no reason to believe that that level of uncertainty is going to be going down anytime soon. So we think that this is something we're going to be living with for a while. And in fact, we can explain some of the change in demand by this elevated level of uncertainty, but the biggest impact was on pricing, which again conceptually made sense to us if you buy into this kind of holding the inventory longer and so forth. And we think that over this 10-year period on average, it was about 50 basis point. But this is 50 basis point difference in the level of ADR growth that we actually saw versus what it might have been had we had, let's call it more normal levels of uncertainty. So we felt intuitively very comfortable with it, but then we isolated just upper upscale and luxury, which tend to capture, they capture a disproportionately greater percentage of the group segment. Then again, it just seemed to make sense to us. So the fact that we don't reasonably believe that you can expect uncertainty levels to begin to dissipate, we're likely to live with that for some time. So here's our forecast. They really haven't changed very much in really the last 2 or 3 years. We do carry this out. We wanted to show you through 2021. We talked about the economy getting weak. That's going to really start showing up in the lodging numbers in 2021. But we do think it's going to be simply a blip. It's going to not going to hang around very long, and it's not going to be that material. If we drill down to just the bigger markets domestically, what you see is it's not quite as big an impact as the smaller markets, but yet we still expect to see a modest downturn come 2021. If we look at the chain scale segments, Here's the impact there. As we've seen historically, economy tends to feel it least relative to the other chain scales. But again, that left-hand scale, the y-axis, at -2 is the, and that's the mid-scale category. So again, relative to historical patterns, it's just not really that big a deal. If you look at our 60 cities, what we're forecasting this year is the supply-demand increases all across the board. You can see it's about a 50-50 shift between markets that occupancy is going to go up or down. Only less than a handful we expect to see a RevPAR decline. Those are mostly in markets that have significant supply growth. If you look at historically where we've been and where we think we're going to end up this year, we've kind of been on this pattern where roughly half of our major markets have been experiencing occupancy declines. So we begin to try to explain, well, why is that? The markets that are going to decline are on the left-hand set of bars, and what we do see in those 28 markets is, on average, it's over 4% increase in supply, and then in those markets, on average, it ends up being a 1.3% increase in RevPAR. The markets where we expect occupancies to go up this year, in fact, supply growth is about half of what we've seen in the other markets, and you see the RevPAR forecast is literally 3 times as great. So, i.e., supply makes a difference, as I think we're all comfortable believing. So I don't want to just stand there and read this to you. We've got about a minute, I think, on maybe we can hopefully a question or two. But again, we continue to feel very good about where we are and where we're headed. A little bit of a blip going forward, but overall, generally looks positive. So I'm done. Do we have, I guess we'll try to, anybody have a question or two, or we can try to answer? Is anybody feeling sad because of what I said? No? Okay, good. Good. Well, I guess if we're done. We're done. Well, thanks for your attention. Thanks for coming.